We are back in the black hole of real estate, and a lot of home buyers have been reaching out asking what is the best way to get a low interest rate in today's market environment. This is your host, Ron Wojciechowski, for the black hole of real estate. I'm going to give you three ways to get a better interest rate in today's market. So the first one is something that's absolutely in every single person's control, and that's to find a way to increase your credit score, because a risk factor that lenders look at is your credit score, right? They want to see your income, they want to see your job stability, other characteristics of your payments, over time, but they also want to see your credit score because that's an indication of your debt to income ratio, and more importantly, how much of your credit that you're using. So what we want to look at right now is, let's just suppose that you've got a car payment and it's in the last year. A lot of lenders will overlook or zero out that car payment if it's less than 10 months to go. So if you have the $500 car payment and you owe $4,000, you can talk to your lender about having the underwriter take that out of the equation. So that will help you on your application, but it doesn't necessarily help you on the credit score. Now stay with me on this, because if you pay it off, and you actually lose a trade line that could be 4 years old. So depending on what your average trade line is, if your average trade line is 10 years, maybe there's only a few trade lines, that could actually shorten your trade line history. So you want to be careful about paying off a car loan or a student loan if it's had a long history, because it's a length of credit that is part of your credit score. Now, let's suppose that you've got a Visa card with $4,000 on it, and you've got a car payment with $4,000 on it. Well, which one would you choose? Well, I would fall back to holding off on the car loan, because that could affect the time that you have in your average credit history. Now, on the Visa card, let's say you're using $4,000 versus a $5,000 line. It's 80% capacity. So what the lender and the credit bureau is looking at is you're using 80% of your available credit right now. You're one car repair away from being maxed out on your credit card. Now, paying that down, that would reset that $4,000 down to zero. Now you're using none of the available credit on that one. Now, if you have other cards, and let's suppose you've got 1,000 here and 1,000 there, and you paid those on, that would open up capacity on your credit line. And that would increase, in most cases, your credit score, but it doesn't wipe out the trade line because you've just paid it off, but it's a revolving line of credit. So what that means is it's available for you to borrow against in the future, maybe after closing if you want to buy some things for the house. So if you had some money and were going to pay off something to increase your credit score, it could very well be that I would recommend you start with the revolving lines. They stay open, it shows capacity, and that you paid things off. And then the other trade lines, you might want the history behind you. If those are, if the longest thing you have in your credit report is your student loan and the car loan, and you wipe those out, then the 1-year-old Visa card, that would be the only indicator of your credit. You want at least 3 trade lines for it. So working on your credit score, it's super important. Before, if you're going to pay something down, maybe consult with your lender or someone who understands credit bureaus to make sure that if you have some money to pay towards it, that you're putting the money in the best possible place. Now, keep in mind, if your credit is good enough or really superior, then paying off a credit line, if you're at 780, getting up to 790, that doesn't make so much of a difference. Now, where it could help you is when you are putting a down payment on the house. If you're putting 3 or 5% down, could you get to 10%? Because if you have 10% equity in the home, that would show less risk. If you didn't pay, then the lender is going to say, well, geez, we've got 10% down. We got $30,000 down or $20,000 down to some number. If we had to foreclose on, we'd probably be okay. And not that you're not going to pay, the mortgage, but things happen. So that would be something that the lender would also look like. So lumping it into your credit score, the first lever that's fully in your control, if you have some extra money or a tax refund or maybe a home sale, as opposed to putting the whole amount down in the home sale, you can look at, definitely a bigger down payment, maybe pay off some credits, but that score is going to be a big indicator of the interest rate that you pay. So that's number one. Now, number two, let's have the seller help you out with a buy down of your interest rate. So the way that interest rates work, there's a par level, and if the rates today were 6.75 and there's no points attached, that's just the rate that you get. And maybe for a half point, you might get it down to 6.625, or maybe for a full point, you might be at 6.375 or 6.5 or something like that. So if you're buying a $300,000 house, that point could cost you 1% of $300,000. It's $3,000. So now again, should we pay off the Visa card, pay off the car payment with $4,000, or could we put the $4,000 towards a interest rate buy down? Because that would lower the rate. Now, I mentioned the seller. The seller can also do that. Some people ask for help on closing costs, but if you don't need help on closing costs, you can still ask the seller to contribute, I don't know, let's say 1% of the purchase price, another $3,000. Now you've got $3,000 from your side, from your $4,000 you had in savings, $3,000 from the seller. Now you got $6,000 to work with, and if your loan size is $300,000, now you got 2 points to work with. That could drive it very close to 6%, and that would save you money. So getting your interest rate down can be bought down. So far we've got two different ways. There's the one that's in your control with your credit and how you would manage that scenario if you had some extra money to pay some things down with your credit. That would absolutely help you. You could buy discount points and also have the seller pay some discounts points for you. So there's two ways. One with your credit, one with your money, right? Now, what's the last way? I would tell you this. There is a real thing brewing right now with new construction. And I realize most people think that new construction, look, it costs too much and it takes too long to build. But there are move-in ready homes from production builders across the country where they have bought credit lines or they have their own lending arms that are doing amazing things with buying down the rates. And it might sound crazy to you, but when rates are 6.75%, in order to get it down to like 4.5%, you might have to pay like literally 10 points. And I've seen this recently where I've had buyers work with a builder, and the builder actually gave them money off on the price of the house and also paid literally 10 points to get the rate from at the time 7 down to 4.5%. And it was a $500,000 loan size. So I mean, the builder literally paid $50,000 on behalf of the buyer to drop the rate to 4.5%, and now they've got a stellar rate. So asking builders to buy down the rate for you if you use their lender is an absolute option. Now, this isn't like a 2-1 buy down where it lasts for like a year or two. This is for life, and it's really something worth examining. So there you have it. You can control your credit and your payoffs and how you, if you had extra money, would pay down something. Now, remember, if you're doing that with the credit bureaus, it takes a while. Mention to your lender about doing a rapid rescore. There's companies that will help you do a rapid rescore. So if you did make these payments on something on your credit line, like a Visa card or a car payment, a rapid rescore, you'd go back and it would generally increase your credit as long as you made that payment. So that's something to look at. Buying down the rate, something you can do, and also ask the seller to help you with by asking for a concession of closing. And the last thing, consider builders, because builders, they've got the title companies, a lot of them. They've got the lending arms, and they've also got the homes. It's one-stop shopping. And they are leveraging their own businesses to keep things going in the construction business. And right now they're playing ball. Right now they're helping buyers. And who's to say 6 months or a year down the road if they'll be giving incentives like this? But right now it's happening. You could absolutely go on your own. Just walk in and do it. You'd work with the builder's representative. I will tell you that in most cases, it will not affect your sales price if you bring in your own agent. They're either going to pay their own agents, and you could use the builder's rep. And whether or not you feel that the builder's rep has a loyalty to the builder, not to you, I'll let you sort out the documents with that. They should treat you honestly and fairly. But you could have a strong negotiator of an agent to go in that understands, hey, not only do I want money off on the price, I would like something, if we're going to do something in the design center, and I'd also like you to buy down the rate. You would like to either know how to do it yourself or have an advocate in your agent, because the agent could literally, air quotes, pay for itself by understanding these strategies. There's 3 ways to help you get a better interest rate in today's market. If you got questions, drop it below. Definitely subscribe. Give us a like or a love. We look forward to catching you on the next episode. This is Ron Wojciechowski for the Black Hole of Real Estate.